Are you accidentally losing tax deductions before your business even opens? I see this mistake all the time with startups, especially cannabis operators building dispensaries, cultivation sites, or manufacturing facilities. They spend serious money getting ready to launch, and then they assume everything is immediately deductible. Well, it isn't. And when those costs are classified the wrong way, it can create tax problems, messy books, and expensive cleanup later on. Today I'm going to show you how startup expenses really work and how they differ from normal expenses and fixed assets, and how one client avoided a major mistake by setting things up correctly. I'm Daniel Sabet, CFO at GreenGrowth CPAs. We work with cannabis operators across the country, and one of the biggest recurring issues we see is poor accounting during the pre-openings phase. Most owners are focused on licensing, construction, staffing, getting open, and understandably so. But decisions made before opening often impact taxes for years. Before launch, most spending falls into three categories. First, you have normal operating expenses. These begin once the business is active. Things like payroll after opening, rent during operations, utilities, software, and ongoing business costs. Second, you have startup expenses. These happen before the business is operating. Think training staff before opening, recruiting employees, consulting during setup, pre-opening payroll, travel, and launch preparation. And third, you have fixed assets. These are items that last multiple years. Things like equipment, security systems, furniture, computers, leasehold improvements like HVAC, tenant improvements, and similar purchases. And this is where the confusion starts. Not everything spent before opening is a startup expense, and not everything purchased before opening is immediately deductible. A common mistake is treating all pre-opening costs as normal expenses. Let's say a dispensary gets licensed in March, hires in April, trains staff through June, stocks inventory in July, and they finally open in August. While many of these earlier costs may still be startup related because the business was not yet open for operations. Once doors open and business activity begins, those same type of costs often become normal operating expenses. That means timing matters. The same payroll account can have complex different tax treatment depending on whether it happened before opening or after opening. Now here's what surprises many owners. Startup expenses often receive the worst immediate tax treatment. Now why is this? That's because fixed assets may qualify for faster depreciation methods depending on the situation. Startup costs often do not. So if you spend money on equipment, there may be opportunities to deduct it faster. If you spend the same amount on pre-opening labor, consulting, or training, recovery may happen much slower. And that's why classification matters. If you accidentally lump equipment into startup costs, you may delay deductions. If you expense startup costs improperly, you create risk. And if you depreciate unfinished assets too early, your books become inaccurate. Now here's an example. We work with a cultivation client building a new facility. They had lighting being installed, irrigation under construction, security systems going in, managing payroll before launch, employee training, and consulting costs. They pretty much had it all. Their previous bookkeeper wanted to expense nearly everything immediately. Instead, we separated costs based on what they actually were. Items still being built stayed in construction in progress. Operational equipment moved to fixed assets once ready for use. Pre-opening labor and setup costs were treated as startup related. That gave them cleaner books, proper depreciation, better tax timing, and avoided a lot of future cleanup. Now, in terms of construction in progress, this is another area people miss. Just because you bought equipment doesn't mean depreciation starts immediately. If it hasn't been installed, tested, or made ready for use, it may belong in construction in progress, or what they call WIP, work in progress, until it is actually placed in service. So if you buy HVAC in November, but it isn't operational until February, depreciation timing may begin in February, not November. That distinctions matter more than most people realize. If you're launching a business, every dollar before opening needs to go into the right category. Some costs are operating expenses, some are startup costs, some are fixed assets. Some belong in construction progress until ready. Get that right early and taxes become easier. get it wrong, and you can create years of unnecessary cleanup. If you're opening a dispensary, a cultivation site, a manufacturing facility, or just expanding into a new location and want the books structured correctly from day one, reach out below. I'm Daniel Sabet with GreenGrowth CPAs. Thanks for watching, and stay sharp.